Thank you. Well, welcome everybody. The purpose of the Strategy Information Forum is to bring together academics and practitioners to learn about innovations in strategy thinking and cutting-edge strategy issues. We've had some amazing speakers over the last 3 years, and having prepared for this meeting, I think we have two amazing speakers today, so I think it'll be really interesting. We have Bob Eccles, who is currently a visiting professor at the Sade Business School in England, and also a professor at Harvard Business School. We have Don Crawley, who's a partner at KL and Gates, a criminal law firm. The two of them met 20 years ago on a joint project and have together become leading thinkers on the issues around sustainability and ESG. So we've previewed their material. It's wonderful. And so I sent you their backgrounds by email earlier. So Bob and Dan, let's talk for 45 minutes, and then we'll take some Q&A for the last 15.
Okay.
So please go.
So you do practitioners and academics. Dan, just so we're clear, you're the practitioner and I'm the academic. Okay, so you're going to say sensible things that are going to be useful to the audience, and I'll just opine on, whatever comes to mind, and it can be irrelevant, but nobody cares because that's what they get from professors, particularly aging professors, right? That's how it goes.
Works for me.
So, we were going to talk about, I guess, sort of the ESG culture wars and things. So Dan and I started working together on this. We call our GOP outreach campaign. It's going on, 15, 16, 17 months now, Dan. Would you say we've been working on this?
I think we first connected, June or July of last year, I guess.
July of last year. So you maybe the way to kick it off, why don't you tell the audience kind of, give a little bit of background of how we've known each other for 20 years, and then, tell them the story as to how we reconnected in July of 2022.
Sure. Of course, we worked together very closely around the time of Enron and WorldCom and the whole effort to identify value for shareholders other than quarterly earnings. You remember at that time it was all about gaming quarterly earnings, and you wrote a book with Bob Herz called The Value Reporting Revolution, which led to XBRL, and it started with you as an advisor to our CEO, Wick Simmons, at the time on value reporting, and I think we were quite effective in advancing the ball on XBRL, and we sort of lost touch with each other until I was reading some of your articles, and Bob, as anybody knows, is a prolific author, and I enjoy reading a lot of what he writes. But some of the things he was writing about Republicans rubbed me the wrong way. I thought they were sort of over the top. So I sent him a note.
Do you remember the title, or have you kind of blocked that? You've got to
block it. I've suppressed it.
So they should know the title. And so just so we're clear, I'm a Democrat. I live in Massachusetts. I'm one of the pernicious progressives that Michael Pence talks about, and Dan is a lifelong Republican, down in DC, but he's a normal Republican. He's not like in the Freedom Caucus crowd, so actually makes it pretty easy for us to talk to each other. But the title, it's one of my better titles, Dan. I'm not very good at titles. The title was Grift Capitalism,
Yep.
The GOP's Brilliant Strategy for Ripping Off Ordinary Americans. Right, Dan? Great title, huh?
Which to me was just a bridge too far, so I sent
it was for me too,
and suggested maybe that was hurting the cause, and that a lot of the people were going to be holding gavels, and I won't use the exact words I used, but I discouraged him from pursuing that path, and he said, find me one Republican willing to go on record defending sustainability and I'll back off. So that started a discussion, which led to a collaboration and a couple of pieces. First one was in the Harvard Law School Forum on Corporate Governance, turning down the heat on the ESG debate, separating material risk disclosures from salient political issues. And that really, I think, has been the theme that we have worked on for the last year and a half or so. It really is about identifying financially material disclosures that are important to investors, or to use a legal catchphrase, that are material to investors, and then match that up with the fiduciary duties of investment advisors or corporate board directors. And between those two sets of issues, the disclosure of material risk information for the benefit of investors and the fiduciary duties of the folks involved in making selections for investments, for retirement plans, or for selecting different options in 401k plans. We have to respect that role. And I think a lot of the anti-ESG effort conflicts with one or the other, and in some cases, both. I was just reading House Judiciary Committee Chairman Jim Jordan's latest love letter to As You Sow.
Yeah. So you've got the actual letter, huh? I read about it on Impact Alpha, so I haven't seen the letter yet.
Oh, it's great. I mean, they come up with some pretty creative language, like ESG cartels.
Cartels.
I understand that when you're pursuing committee jurisdiction, you have to operate within the jurisdiction you're given, and they have jurisdiction over antitrust. It doesn't mean that it makes any sense at all to be pursuing people trying to save the planet for collusion, particularly after the same set of characters have been telling us for 4 years in the context of the Russia investigation that collusion is not a crime. But now it's supposedly a crime to collude to save the planet. It's just a little nutty to me.
I mean, it's been interesting because the way I see this, so Dan is in DC and he's an expert in things Washington, and I'm kind of like he's my tutor in terms of how Washington works. So over the past year, we've observed a lot of this, red state attorney generals, and they're trying to pass all of these laws in these red states that you can't do ESG, and they say asset managers are boycotting fossil fuel firms, so they're going to boycott them. And this legislation makes no economic sense whatsoever, right? It's like they're basically saying, if they could get it right, you can't take account of material risk factors because you call it ESG, and we don't want to have that. It'll cost Texas $300 to $500 million for this bond issue that they did. In the one in Indiana was an independent group in Indiana association said it would cost taxpayers $6.7 billion. So you've got this culture war going on where you've got sort of the wingers, the Freedom Caucus crowd, imputing ESG to be this, kind of the cartel of global elites. So the Republicans, this is great, right? The Republicans are all nervous about global elites. And the Democrats are all worried about dark money. That's what it all comes down to, global elites and dark money. So most of these bills haven't been passed. It's like a 25% success rate. In Wyoming, they were trying to pass some of these bills. Every business association, banking association, the Petroleum Association of Wyoming objected to it, and it didn't pass. And so there's this level of political theater. Then Dan and I go to the Hill, and we meet with staffers and with congressmen, and we meet on both sides of the aisle. And, we're meeting with, kind of the normal people, not the Jim Jordans and the Jim Comers of the world. And they're very convivial, constructive conversations. We agree about the importance of materiality, the way Dan was talking about. We agree about the importance of fiduciary duty. There's some differences of opinion. We can get into this that people can have on what the limits of authority are of the SEC and, what their authority is to issue a climate disclosure rule. And my view of it, Dan, is that the people we're talking to some extent, and you see this in what happened with the new Speaker of the House, it's like the tail is wagging the dog and they're kind of hostage, to this kind of very loud, very right wing. And they kind of know better, and so you had the Comer hearings were a joke. I mean, it was political theater and these people were idiots and the things they were saying didn't make any sense. The House hearings under Patrick McHenry and Bill Huizenga, those were quality hearings. There were substantive issues. There was like agreements and disagreements, but it was, I thought all intelligent. And then they had these 19 bills, and you've read all the bills, Dan, you know it better than I do. And then they were packaged up into 4. And so then here's kind of the puzzle that we can discuss a little bit for the audience, because as you've explained to me, because we know where there's bipartisan agreement. I mean, we've had these conversations on the Hill. We did that webinar with Allison Heron-Lee and Tim Doyle, who's at the Bipartisan Policy Center that I've written about with Arissa. And she was an SEC commissioner that basically led the effort to have a climate disclosure rule. But those 4 House bills as you explained to me, were kind of structured in a way as to not be bipartisan. So like, how did that come about, and kind of what do you think the current state of play is for what's going on sort of in Congress on these issues?
Well, sure. First of all, let me just say that you mentioned Jordan and Comer, but I think it's important to recognize that there are now 5 House committees looking into ESG. The Ways and Means Committee has announced that they're going to have a hearing on ensuring that woke doesn't leave Americans broke, protecting seniors and savers from ESG activism. That's in the House.
I'm a senior, so I'm glad someone's looking out for me. I'm a very senior. George and I are seniors. So
yeah, we are.
About that, by God. That's really good.
Now the Education and Workforce Committee is looking at the DOL ESG guidance. So we literally have 5 House committees looking into this. Interestingly, only one committee has any real jurisdiction, and that's the House Financial Services Committee. You mentioned Patrick McHenry. He's a very shrewd operator who understands both the substance and the politics of the issue. And he worked with his top lieutenants. You mentioned Bill Heisinger, but also Andy Barr, French Hill, and others, to come up with a set of issues that you or I might disagree with, but at least they're real issues. It's not this made up stuff like trying to cram Climate Action 100 into an antitrust violation. I mean, that clearly just makes no sense other than for politics. But the Committee of Jurisdiction looked into ESG across the full possibility of issues to focus on, and basically boiled it down to 3 buckets. The first one is SEC Rule 14A8, which is the rule that governs the proxy voting process. Second is the regulation of proxy advisory firms, and in particular, whether there should be more competition. There's a desire to break up the duopoly in favor of more robust competition, and to require record keeping and registration for the first time. And then the third bucket is this question of who votes the proxies on behalf of the beneficial owners. If I have an account at Merrill Lynch and I'm invested in a BlackRock fund, Larry Fink sees the omnibus Merrill Lynch account, but has no idea who I am. And the question is, should he be voting proxies on behalf of me? He has no idea what my personal views are. And so those 3 areas, 14A8, proxy advisors, and voting of proxies on behalf of the beneficial owners, are really the 3 issues that they've taken away after 6 months of investigation, a full month of hearings, anti-ESG month markup you talked about, which has resulted in 4 bills. It started as 19 bills. And you sort of alluded to this, Bob. They were packaged in such a way, seemingly, to preclude bipartisan support. And the reason for that is that this is really mainly a political issue. The substance takes, a back seat. And they want to keep the issue alive going into 2024. They see it as a winning issue. It's part of the anti-woke crusade, if you will. Whether that's true or not, I don't know. I mean, this is the same crew that thinks it's a winning political strategy to take away women's health care. So I question their judgment, but that's the motivation for keeping it alive and for packaging the bills in such a way that they keep Democrats off so that they can maintain the talking points. And the irony of that is that when you look at the underlying provisions, any number of them were not controversial or potentially susceptible to bipartisan support. The Mandatory Materiality Requirements Act in particular is the kind of thing that you and I have both embraced in writing several times, because that's really what this debate is all about, is material risk disclosure for the benefit of investors. So mandating that disclosures be material is fine with us.
Sure, go ahead.
And that probably could have gotten some bipartisan support, but not when they married it with the HR 4628 to amend the Securities Exchange Act to require the SEC to disclose and report on non-material disclosure mandates and other purposes. Well, that's just silly. I mean, Congress tells the SEC what their job is, and then to have the SEC tell Congress what job they're given that isn't relevant or material is just silly to me. But those kinds of bills were added for political reasons, not for substantive reasons. And for that reason, these bills will all go to the House floor. They will probably pass the House, and that's where they will stop. And again, any number of these provisions, if they were moved individually, could have passed with bipartisan support and probably the Senate. When you look at when the first presidential veto was with respect to a joint congressional resolution to overturn the DOL ESG guidance, and two Democratic senators, Manchin and Tester, voted for it. Ultimately, the president vetoed the resolution. They didn't have the votes to override the veto. But the point is that if you had two Democratic senators support that provision, there are any number of other provisions in this package that likely could have gotten their vote. And for whatever reason, the Republican leadership chose to make it a partisan exercise, precluding that possibility.
Well, and if you look at those three things, it's interesting because you've got on the shareholder proposals, you have now this raft of anti-ESG shareholder proposals. And there's an irony on this because the right has been basically and kind of started with Pence, I think, and then good old Vivek Ramaswamy saying, well, that the left is trying to use shareholder proposals to influence for cultural and political and ideological reasons the behavior of companies. The anti-ESG proposals are basically trying to do the same thing. The proposals to say that investors can't invest in Chinese stocks is basically the same sort of logic around, it's the same format of, okay, we're going to boycott, asset managers that we say are boycotting fossil fuels. The proxy thing, I mean, gosh, I think that's something you could easily get bipartisan support on. You've got two, there's this duopoly, there's potential conflicts of interest. And the voting of, the ultimate beneficiaries, that could cut both ways, right? And you say, if you could sort of figure out the mechanics and the logistics and stuff so that every individual can find a way to vote their shares, you might have more shares for climate proposals rather than less. I mean, and it could change over time. And if you look at, generationally with climate change, the differences between Republicans and Democrats are much less than they are, as you get younger. But just as an aside on climate change, I mean, we've run into this, Dan, a lot. I mean, you have a number of conservatives, Republicans, libertarians, very concerned about climate change. I mean, incredibly thoughtful about it and looking at how to address this in very different ways than, kind of my crowd. And I'm quite enthusiastic about, a lot of stuff that's going on in conservative circles. On the issue around, Manchin and Tester, I guess it was, this is an example of where the political theater is like far ahead of what the substance is. So why don't you tell the story of what happened in the Trump administration with ERISA, and then I'll tell the story of what happened in Biden, and then I'll talk a little bit about that piece I wrote with Tim Doyle. But you kind of observed it more from the ground, what was happening under Trump.
Well, sure. I was on the Trump transition team long enough to appreciate that their top two targets were the SEC fiduciary duty rule and the DOL ESG guidance. Really top target. And they spent 4 years trying to do that. By the way, my time on the Trump transition team was coterminous with that of Chris Christie, because when they figured out there were a bunch of never Trumpers in the transition, they hit the reset button and started all over again. Frankly, I don't think they ever recovered from that move. But in any case, they spent 4 years trying to put the toothpaste back. Finally had Eugene Scalia, who was then Secretary of Labor, came up with this idea of requiring focus on pecuniary returns, which is fine. That's what it's all about. In fact, I think that's implicit. So if you want to make it explicit, that's fine. But that really was the fight, is, after, and by the way, they took 4 years to come up with that solution, put it in October or November, just before the election and on their way out the door. So, of course, the Biden team, it became their top agenda item to correct. And so that football has gone back and forth. But the truth is that the substance hasn't changed much. The political rhetoric would make you think it's a 180-degree difference each time, but it really isn't, because the fundamentals are enshrined in ERISA, the role of fiduciaries, the focus on returns, the focus on benefit to the ultimate beneficiaries is bedrock fiduciary law under ERISA, and none of that gets changed by the wordsmithing on the guidance.
I know it was changed. I mean, for 50 years. I mean, ERISA has been around 50 years. Duty of loyalty, duty of prudence, and it was great to see what happens, right? Because then the Trump comes out and they go pecuniary material. It's like, okay, that's what ESG is. We're talking about material issues. That's SASB. These things that matter to shareholder value creation. I'm not the one that's saying ESG is this woke thing, right? You know, that's Pence and Comer and who all these other people are in the Ways and Means Committee, this confounding. And so you can define ESG and say, well, it's this woke exercise. That's not what it's being done by asset managers, and that's not how it's being done by companies. But if I believe, you know, ESG is pecuniary, then my crowd freaks out, you know, when the Trump administration changes the rule and all these letters go in. And, you know, then Biden does his thing and the other crowd freaks out. The Wall Street Journal goes, oh, you know, the first bipartisan thing, you know, and then rejects it. And what was the language difference? Pecuniary material economically relevant. Explicitly, it says you can't sacrifice returns for ESG in the Biden rule. Of course, you know, the Wall Street Journal is, oh, and then you've got to sacrifice returns to pursue a socialist agenda and do ESG. The language goes like this, and the political rhetoric goes like that, you know, and it's this incredibly fundamental disconnect between the political theater that's going on when these House hearings and this stuff in the red states. I'll give you two other great examples of the political theater that's just extraordinarily entertaining to me. So Florida passes its, you know, anti-woke, anti-ESG bill. And I read about it on the Harvard Law School Forum on Corporate Governance. Simpson Thacher says it's the most far-reaching anti-ESG bill ever. And I think, oh my God, the most far-reaching. I mean, these people have been working hard. So I go and I read the bill and I look at the website where Ron announced it. And he goes, you know, and was like, you know, a bill for corporate and something activism. And there's like this little symbol woke with a line crossed through it. We finally killed woke. Okay. And it's like he's promising, you know, his crowd that they've finally slain the woke monster. And then my crowd's going, oh my God, look at what they did in Florida. What does it say? It says you should vote on pecuniary material issues. No social, political, or ideological preferences should come in. I'm fine with that bill, you know? It's like, look at the language. Don't look at the political theater. My other example, and maybe we can talk next about the SEC's authority. So in January, end of January, I forget the gentleman's name, the Attorney General of Alaska announces a press release that he signed on with, you know, the other 23 or 24 red states to sue the Biden administration, you know, on this ERISA rule. And he's very proud to be saving America for, you know, all of us, well, people like George and me. And then at the end of May, the governor issues the first sustainability report for Alaska called the Alaska Standard. So I read the report and it's really quite good. And you sort of look at the table of contents. It talks about the sustainable development goals twice. It talks about, you know, eliminating sort of economic inequity, right? It talks about social impact. It talks about responsible use of resources, making the world a better place. The super left, the sustainability Taliban, they don't like ESG because it's not making the world a better place. It's just about shareholder returns. So Alaska, man, they've gone far beyond ESG, right? They're like, you know, here's how we're going to make the world a better place in Alaska. I mean, it's really good. Then you read the letter, you know, from the governor, and he goes on about, oh, and by the way, and then they hired an ESG sustainability consulting firm to help them put the report together. But then the governor, because the Republicans have created this like complete just fantasy around what ESG is, has 2 paragraphs in there saying, and oh, by the way, just because we published the sustainability report doesn't mean we have anything to do with this ESG. There's no ESG principles in this stuff at all. I'm thinking, you're like Rubber Man, you know, turning yourself into a pretzel or something, trying to divorce yourself from this thing that you've made up that isn't even real.
That's, you know, Bob, that's a really good point. Is that in many ways the whole fight over ESG is a proxy war, right? Yeah. It's like a Rorschach test. You read into ESG what you want, and then attack the other guy for disagreeing with your conception of ESG. And I think that's really the main value that you and I have brought to the debate is trying to clarify what ESG is and what it isn't, because it isn't what, you know, most of the antagonists are saying about it. I'm still having trouble getting my head around ESG cartels. I mean, where is the anti-competitive market impact or the restraint of trade? To me, it's the opposite. This is capitalism on steroids. This is competition writ large. This is what Hester Peirce calls the climate industrial complex. We've got all kinds of businesses cropping up to deal with these issues and to meet these challenges. That's good. That's innovation. That's creative destruction. That's what capitalism is all about. So to label the sustainability movement as an antitrust violation is just wacko to me.
I hadn't seen the CSG cartel. That's good. I'll have to read the letter. But what's interesting is that my sense is, and I've tested this pretty well, and we can kind of get a sense from the audience. Are companies fundamentally changing what they do? No, or maybe they're talking about it a little bit. I don't think there's a lot of greenwashing. Maybe they're being a little bit more authentic in how they talk about it. I mean, next year at Energy, which qualifies for the Point Bridge America First Fund ETF MAGA, their website says leading America to its net zero future. They've got targets, for scope 1 and 2 reductions. They're the 6th largest capital allocator on climate change. ExxonMobil has got a sustainability report organized in terms of ESG. Is this stuff going to change because of the stupid kind of culture war? No, they're focusing on material issues. ExxonMobil, in its 10K, discusses every single material issue that SASB's identified for, oil and gas exploration. Same thing on the investor side. I mean, they're not pursuing some political agenda. They've got a fiduciary duty to their clients. They're limited somewhat by the lack of good data from companies, which gets us to disclosure. But they have to earn a return. So they're looking at what the ESG issues are that are going to matter for a return. And I think, that then raises this issue. And maybe let me flip it back to you, Dan, because you do have groups that are working on trying to get better data being reported by companies for investors so they can make these decisions. And well, maybe let's start with the SEC. And I'd like to get your views on its authority, because this is, a place. So I wrote one of the quick thing, with Dan's help, I wrote a statement for the House Financial Services Committee, and it didn't get read into the record because, Republicans didn't agree with everything I said. They agree with a lot of it, but they agree with some things. Democrats didn't like I said nice things about Republicans, and so whatever. But there is, I think, an important issue about SEC authority that's being debated to issue a climate rule. So maybe talk about that a little bit around the scope 1, 2, and 3.
Yeah. Well, first of all, I don't think there's any doubt that they have very clear statutory authority to promulgate corporate disclosures. They've done it since 1934. That's really not the issue. The issue is after EPA versus West Virginia and the delegation doctrine, what authority did Congress give to the SEC? And I would suggest it is to require disclosures on financially material risks. It is not to promulgate disclosures on externalities or what the Europeans call double materiality, which really is what scope 3 is trying to get at. Greenhouse gas emissions, downstream and upstream suppliers, etc. That becomes very difficult from a data standpoint. We don't have standards yet, and we need to talk about the need for standards. But we very clearly have a different approach in the U.S. based on our system of federalism and the laws that we have that govern the SEC's disclosure regime. And the Republicans are pushing back on efforts to require scope 3 greenhouse gas emissions as beyond the jurisdiction of the SEC. It's something that's more in the province of the EPA, not the SEC. Interestingly, California has now gone whole hog in scope 3 across all business enterprises, including law firms. Large partnerships that do business in California will have to comply with the California statutes. And we have CSRD in Europe, which of course is scope 1, 2, and 3 and double materiality. And that's, it's a more comprehensive disclosure statute. More problematic is the CS3D, the Corporate Sustainability Due Diligence Directive, which goes way beyond disclosure and would mandate changes to corporate board responsibilities, management policies, and procedures. It would essentially rewrite Delaware corporate law from Brussels. So I just want to flag CS3D as an issue that requires some attention. But in terms of where we end up, the SEC will probably have to make some changes to scope 3 in order to survive judicial scrutiny, meaning that there will not be a level playing field with CSRD in Europe. and there will need to be some sort of a private sector solution to bridge that gap. And the need for standards is manifest. I was at the University of Maryland Smith School of Business 25th anniversary, silver anniversary last Monday. I'm a triple terp, so I got to sit with all the finance professors, and some of them are working on really interesting applications of AI, including on sustainability, where they're taking company reports and dissecting the language to assess where they are headed in sustainability. And it occurred to me that they're using AI to compensate for the lack of standards. We have 85% of the S&P 500 now complying with TCFD or making sustainability disclosures in accordance with TCFD. But those disclosures are not standardized. They're not comparable. They're not useful to investors. And so the whole investor-led movement for greater disclosure of material risks has led us to a point where we really need to think about what that global baseline for sustainability disclosures looks like. To my mind, ISSB is probably best positioned to play that role. It would be comparable to the role that FASB plays on US GAAP, which is a critically important function, private sector led, with input from all stakeholders over an extended period of time to ensure that you've come up with the correct standard, keeping politics out of it. Accounting standards are not the province of legislation, and neither should sustainability standards. And it's important to have experts that understand the issues promulgating the standards, not government bureaucrats or politicians with an ideological axe to grind, because the disclosure should be based on what's material. And that's a relatively objective assessment. So we need experts that can help promulgate those standards and take the 85% of the S&P 500 that are already complying with TCFD as they migrate into ISSB. That gives them the ability to meet the European regulatory requirements, California requirements, whatever the SEC comes up with. And I think that that's the most likely path forward, for the very simple reason that until we have one world government, and as long as we have competing nation states, there will be competition among the regulators, and that's healthy. And we can talk about harmonization and convergence, but at the end of the day, the UK is not going to follow the EU blindly. That's what Brexit was all about. And the US certainly is not going to follow the Europeans. It's like the tail wagging the dog. We have 4 times the amount of capital in terms of publicly traded companies, equity capital. It's about 42% in the US global capital. The Europeans have about 11%. Chinese have a roughly comparable amount. So basically, the US capital markets have twice as much capital as Europe and China combined. And the idea that the Europeans are going to dictate corporate governance for the rest of the world is a little silly. But again, that's sort of where we are. And I think the SEC is stuck trying to navigate both judicial review, surviving judicial scrutiny on scope 3, but also trying to come as close as they can to the European regime in order to have mutual recognition and substituted compliance. So those are the objectives. I think to some extent they're at odds with one another, and that's why the SEC has not issued its climate risk disclosure rule. But we expect that to happen sometime between now and April, for the very simple reason that if the election goes the way it's looking likely to go now, then the SEC has to be mindful of having their rules overturned under the Congressional Review Act. And so they are going to have to act at some point in the next 5 months, we think.
So let me just put in a little plug, Dan, for the ISSB. You mentioned the global baseline and you talked about some of the private sector. So I think it's important. So basically companies that are operating in Europe, and if they've got a listing in the US, there's going to be kind of 3 reporting regimes they're going to have to deal with, whatever the SEC rule turns out to be. If they're operating in Europe, it's a directive, it's a law, so they've got to be in compliance. And the double materiality is like, you read it, it's really impact material. It's all about the externalities that you were talking about. And there's almost, when you read ESRS 1, in contrast to the IFRS 1, which is the general standard from the ISSB, there's no discussion about the relationship between these disclosures and kind of company performance in terms of cash flows and profitability and so forth. And the theory is that if you get companies to report on every imaginable negative externality, somehow they're going to go away. And I think that's naive. The ISSB, it gets criticized, by the Taliban because it's only financial materiality. That's his job. right? Its job is the input is from investors. What is the information investors need? Just like what it is, that FASB does here. And so you take the voluntary, because it's got to be voluntary because they're a standard setter. They're not a government. But as you and I have been talking about, we think that the ISSB is the base, can establish the global baseline. You get it kind of harmonized where there's standards from both FRAG and the ISSB, and then we would encourage companies, particularly here in the US, all over the place, to on a voluntary basis, because governments aren't requiring this yet. I think some are thinking about it. My guess is, Dan, is that wherever the SEC comes out, because scope 3 is in ISSB, but there's a materiality filter. I think if companies were adhering to S1, which is the general requirements, and S2, the climate disclosure in the ISSB, I think they'd be in pretty good shape with the SEC. But then there's this broader issue of Europe where it's kind of trying to use reporting to do more than it can. And this kind of single versus double materiality debate, it's basically a proxy war over corporate form and company law, and then that's a good discussion to have. And, there can be differences of opinion, I like public benefit corporations, maybe you don't, but let's have that discussion rather than this kind of just incredible amount of emotion and anger and angst that exists in the reporting community about single and double materiality. I think US companies, 85% TCFD, a lot of the big ones are doing GRI. If you're doing ISSB and GRI, you basically have covered yourself from what the requirements are out of FRAG CSRD. Whether, the European Union will ever recognize that, that's a separate question, right? I mean, they're a government, and they do what they're going to do.
But the thing to remember, and, from the standpoint of the corporation or executives in publicly traded issuers, is that this whole movement is being driven by investors for investors, and that dynamic is going to continue. The SEC is sort of playing catch up, right? We've already got 85% of the S&P making sustainability disclosures. The SEC hasn't issued their first sustainability disclosure rule yet. The Europeans have lots of mandates, but no data, and companies trying to come up to speed with the mandates that are being issued. So I like to say the Europeans are far ahead of their markets. US regulators are catching up to their markets. But at the end of the day, these are market forces. And that's why this sort of antitrust, collusion on ESG cartels is just silly to me. This is sort of the definition of competition and innovation and creative destruction. So I think that so much of it has been what's the word I'm looking for? As Daniel Patrick Moynihan famously said during a debate, the gentleman is entitled to his own opinion. He's not entitled to his own facts. And that's what's happening. People, facts about ESG and then debating that without ever stopping to say, does that make any sense at all?
Just one last thing on the plug for the ISSB. So I before this webinar, I had a call with some people in an accounting firm who are kind of deep into the weeds on this. And they pointed out something that I hadn't really realized, that one thing that companies are sort of looking into to be in compliance with, the EU regulations is because right now it has to do with your operations in Europe. So how you kind of define a legal boundary, which is a subset of the entire corporation, and report on that. Whereas the reporting from ISSB would be on the full corporation, as opposed to be in compliance with the EU. It's going to be just for what the operations are in Europe. So that's interesting. Another thing, and I'm working on a little piece on this, so I'll be careful in what I say. Don't want to steal the thunder of my co-authors, but the ISSB did an analysis of the SASB standards, because that the ISSB absorbed SASB, which was developed in the States, and I was the founding chairman, as people probably know, and it was financial materiality, and it was industry specific. And so there was an exercise that the ISSB went through to basically test how international these standards were, right? Could they be applied in a global context, or were they too US-centric? And what they found is that for the most part, they're all pretty international. You kind of substitute language on a particular, US law around reporting for a certain industry, a standard that's been developed, and you say the appropriate jurisdiction, kind of language around diversity, equity, inclusion changes some based upon where you are, because that's culturally specific. So you've got the possibility of going down to industry level stuff, basically generalizing from SASB. But then you have the challenge is that the EU under the CSRD, under FRAG with their Sustainability Reporting Board, they're talking about developing their own sector specific standards. And that could be a mess, right? Because if they come up with a different sector classification system with different industries underneath that. So, SASB had 11 sectors, 77 industries. So if the EU comes out with a separate classification system, then a separate set of, what they think the particular things that should be reported on, even from the financial materiality point of view, it'll make it even more difficult creating this global baseline. That's what companies want. That's what investors want, right? Investors, would like to be able to compare companies in different countries that are in the same industry for making their investment decisions and not have to worry about trying to, reconcile and make the adjustments on a bunch of different disclosures that are coming out from different regimes. But again, that's out of our control, right?
Okay, gentlemen. Go ahead, Dan, and then I think we need to open up the Q&A.
You touched on an important point, which is that when Scope 3 disclosures are material is to be determined by management. And that's really important, because what we're talking about from the standpoint of the investor is disclosure of risks that management knows about, right? This is not an exercise in data creation. This is attempting to avoid our past history, which is one of management concealing known risks until it's too late for investors. And we saw that repeatedly throughout the 90s in Enron and WorldCom. We saw it more recently with Silicon Valley Bank. And that really is, telling management to disclose known risks is what we're talking about, not something different than that.
Good. Well,
George, you're on mute.
Thank you, Dan. So you've generated a flurry of questions. I think much more than we have time to get through, but I'd like to put a few of them out. One question I thought had an intriguing angle to it is there any historical precedent to the environment we're in right now?
Yes.
That we could learn from?
It's funny. I was counsel to Speaker Gingrich during the impeachment of Bill Clinton. And at the time, we were told things have never been this bad. They've never been this partisan. We certainly hear that today. Kevin McCarthy was just removed as Speaker after being the most deserving member of the House Republican Conference. It looks bad, but it has always been bad. That's democracy messy. I mean, we used to have fist fights on the Senate floor. They used to have duels on the grounds of the Capitol. I mean, things have always been partisan. And that's really the brilliance of our system, is that we have full and open debate, which is protected speech under the First Amendment and separation of powers. And at the end of the day, we make a decision by majority vote. That's a democracy, and that's healthy. And so, yes, democracy has always looked the way it does.
There's a colleague named Eli Lair who's founded the Yar Street Institute. Very, very smart, thoughtful guy, libertarian. And he wrote a piece in American Purpose called "What a Swell Party It Was," about this divorce that's happening between the GOP and big business. And so it's like things are topsy-turvy. The GOP is becoming, kind of the populist party and all that stuff. So, and as he pointed out, he said there's been, in the course of American history, 6 major realignments, parties stand for. And only one time did that lead to a civil war.
Yep.
So that's the good news. We're not quite. So it's bad, but it's been worse.
Okay, good. Another group of questions that have come through is, okay, so what do individual companies do? How can they participate? How can they participate in this discussion of issues, and how can they do anything to make an impact?
Well, first of all, I think from the corporate perspective, you have to look at the sustainability movement as an investor relations issue. It is first and foremost investor relations, but it obviously has much more to it. One of the reasons I don't like ESG is that it is so politically charged. Like DE&I, or set aside the E, even the D&I. I mean, there are politically charged terms in there, which is why I like to talk about sustainability, because sustainability to me is unassailable. It should be taught in every business school in America. It's about long-term value creation. And if management is focused on long-term value creation in a sustainable way, that's a good thing. It's going to mean, more higher profitability over time, just intuitively. We don't have data yet, and a lot of people like to talk about how ESG funds underperform. Well, give it time. I suspect that well-managed firms that are focused on sustainability will be more profitable in the long term. Just that's sort of intuitively makes sense to me, but the data will prove that out over time. So I would focus on, what are your investors asking for more than what Jim Jordan is saying on any given day? Because at the end of the day, these are market forces, and that's what's going to determine the outcome here. The regulators will catch up eventually. But, keep in mind, as I said, the whole reason the ESG bills were packaged the way they were was to keep the issue alive until the 2024 election, with an eye toward potentially having gavels in January of 2025. But by the time we get there, the market forces will have continued to evolve. By then, my guess is we'll have a significant chunk of the S&P 500 filing sustainability disclosures in accordance with the ISSB, and the SEC will issue its climate risk disclosure rule. The European regulators are far less realistic about their ambitions. What's interesting to me about the materials they put out is if you read through it, there's no discussion of economic growth or profit or return on investment. Those concepts are not even part of the discussion. It really is about saving the planet. And because Europe is so small relatively in terms of the greenhouse gas emissions, China is far and away number one, US number two. Germany is the only European country that even cracks the top 15. And yet they've got these legal mandates to reduce their greenhouse gas emissions. The only way to do that is to dictate how companies outside of the EU are governed. And that's the source of CS3D. And I think it's going to result in a fairly significant pushback from the US. Fortunately, it may not survive the trilogue process. We have an election coming up in April, and it's expected that the political politics will shift to the right, and therefore they may never come back to it. But in the meantime, it's important to remember that Bernie Sanders would be a centrist in Brussels. And that is not an exaggeration. It's not an exaggeration. And so having that mindset dictate U.S. corporate policy from afar is just not going to fly.
Let me reference an article for you can send around to your group, George, that I published in the July-August Harvard Business Review called The Evolving Role of the Chief Sustainability Officer, that I wrote with Allison Taylor. We interviewed 26 companies and 32 asset managers. And I won't get into the whole thesis, but the short version of it is that the role of the Chief Sustainability Officer is going through some major changes. And when you say, what should companies do? I think that there's kind of I'll take it down to two things. Number one is companies can't have in their materiality matrices, all these companies do 20 or 30 things in the top right-hand corner. That's just ridiculous. Nobody can pay attention to 20 or 30 things. What are those things that are existentially important? It's 2, 3, 4, maybe 5 at most. Companies need to have much more discipline on what the sustainability issues are that matter to value creation. And they need to be more candid about trade-offs. Companies have a tendency to say, oh, we're going to take care of all of our stakeholders and all it's going to be good. And over the long term, it's all going to work out. And that's bullshit. You've got limited resources. You've got limited capital. Be clear about what you can do. Be clear about what you can't do. And make sure that when you're meeting with your investors, you're explaining the way sustainability fits in. And you're not just publishing a sustainability report for stakeholders and NGOs and then having a separate conversation with your investors, which is still kind of the dominant thing, but that's changing rapidly as you see the role of the CSO change, reporting into CFOs. These standards are going to require CSOs to have much better internal measurement and control systems. So, you can send people my article and get my rant with Allison.
Yep. We'll have to figure out how to handle the trademark.
No, it's in the public domain. Just send it out.
Okay, I'll check it out. A large part of the audience are academics, scholars.
Professors.
How would you influence their agenda, the type of research they could be doing to make a contribution to getting us through this period?
I mean,
I guess,
go ahead.
I mean, one thing you mentioned a few times is data, data, data. There is none, there is none, there is none.
I mean, I think it's tricky with academics. There's the data problem, but there's ways that you can kind of deal with it. So a model for me of, a kind of high quality business school professor who does rigorous research and gets published in referee journals, but also can speak to a practitioner audience is a guy named Shivaram Rajgopal, who's an accounting professor, at Columbia. And you guys got to call him on Forbes.com. You should look him up. I think the challenge for academics is that, if they're junior faculty, they've got to publish in referee journals. And it's like there's all the restrictions in terms of, kind of what they want and the paradigms and blah, blah, blah. To be honest, I don't see for the most part, I mean, there's exceptions. The extent to which the academic community is really kind of part of this discussion, whether it's the culture wars or the data, some of these studies, company performance, George Serafim does good stuff, investor performance. It's the big consulting firms like BCG, it's law firms, it's search firms, it's the accounting firms. The people that are engaged with the corporate and the investment community are more practitioners, not academics, to be honest.
So they should be doing the relevant research.
They should be doing relevant research, but their hands are kind of tied, right? Because relevant research, the things they've got to do and the studies they have to do, and they've got to have the literature review and this and that in the referee journals, takes 2 years to get something finally published in a referee journal. Man, a lot happens in 2 years.
Yeah.
So it's like, it's kind of hard. I mean, for academics to contribute to this stuff, they have to decide that, they're going to kind of focus more on things that they can do that practitioners would find useful. And they're going to have to give up on kind of getting, the brownie points from publishing in referee journals.
Okay, good point. I have a question.
Sure.
In some of the writings that I've reviewed in preparation for today, I ran across a phrase, I think it was you, Bob, that said on climate change, quote, I didn't start from either the left or the right. And what struck me is, what is life like in the middle? Because you got an unhappy left, you got an unhappy right, and now you're in the middle.
Well, it's a problem because the middle is kind of lonely.
Yeah.
And to make the middle bigger. I mean, the middle is kind of still fairly lonely in the ESG culture, whereas the stuff that Dan and I are doing, if I had to sort of very quickly kind of paint the left and the right, the left is trying to drive the energy transition through the financial services sector with groups like GFANS and so forth. And then the left is much more focused on, I think, more practical issues around physical things like getting permitting for transmission lines and doing mining, and more willing to sort of, meet the trade-offs. I've met now a lot of conservatives on climate change. They say, when you talk to the people on the left in my crowd, how does it go? And they say they blow us off. So a major focus, a part of what Dan and I are doing, because we're not experts on climate, but we want to get people that really are experts on climate, but look at it really quite differently. There's a great example. There's a guy named John Skirvin, who's the CIO of Utah Retirement Systems. We wrote a piece called Climate Change, Misguided Activism, and a Roadmap for Institutional Investors. Those are the people that should be engaged with. I know Greg Goff on the board of ExxonMobil. There's a group called ClearPath run by Rich Powell. There's R Street Institute, a guy named Philip Rossetti that I've published some pieces with. If you go look at Real Clear Energy, there's a lot of really substantive work being done by conservatives that I think the left just isn't even aware of. So, kind of, I don't want to be sort of in the middle because I'm not the expert, right? How do you sort of bring these people that are experts that come from very different political, perspectives to talk about a common problem? Because unless you can get that bipartisan conversation, you're not going to solve climate change.
Right. Now, in another one of your writings, you mentioned something called just transitions. JUST transitions, which struck me as a way of living in the middle. Can you say more about just transitions to our group?
So, if you look at, again, sort of how the language is used sort of in my crowd, a just transition, is often put in the broader geopolitical context of, the emerging markets. And it's like when we transition to a net zero economy, we've got to make sure, that we're bringing along the emerging markets. And I wouldn't put China in that. I think China's just a big problem. Because they need to, be able to, increase their lifestyles and have the energy. And I get that. And I think that's important. But a lot of the funding from that has to come from governments. I've written about that. What's ignored in the just transition, I think, and this is kind of part of the political issue, and where you have people in the red states that I don't think they understand the issues all that well, but you can understand the concern. Just transition means that, kind of Joe Sixpack in red states and blue states that can't afford an electric vehicle to put in heat pumps and needs to have gasoline for their pickup truck because they're in the construction trades, you can't leave them behind, right? And so you're not going to get everything renewable energy overnight, and you're going to have more natural gas than the purists would like for a long period of time. So for me, a just transition is it's not just, the wealthy countries and the wealthy people, whether they're in emerging or developed economies. It's, all of these people that, are kind of living more day to day. You need to have an energy transition that accommodates their needs as well, and not be so bloody purist about we're going to make all the fossil fuels go away, which is just nutso.
Dan, Bob, we've used up our hour. It's been a very full hour. A lot of great compliments in the chat and the questions. Thank you very much from all of us.
Yeah, and thanks for the opportunity. It's always good to have fun with Dan, and nice meeting you, George. Take care.
Take care.
Thanks for having me.
You guys.
Bye-bye.
Bye-bye.